Technical analysis is a real skill set that will give you an edge in planning for entries, profit targets, and risk levels. But it won't help you much if you only know the basic support and resistance or some random indicators. I've been chatting with some of the most profitable traders in the industry today. These traders are successful and consistently making winning trades every year because they have real edges that help them adapt to different market conditions. They don't just trade support and resistance or some sort of signals. When these pro traders analyze their charts, they're thinking beyond the basic price levels that are simply too obvious. In this video today, I want to share with you 4 crucial technical analysis techniques that help you become more structured and improve your edge when analyzing charts and preparing for your entries for various trading strategies. This is a no BS guide. If you pay attention, you can apply these 4 real edges to your trading immediately and see progress tomorrow. The 4 key technical trading concepts you're going to learn today are: Number 1, key levels formed by psychological price action. These are not just basic support and resistance. Instead, we're looking at previous day's closing price, all-time high breakouts, pre-market levels, and high probability price movements such as red to green and green to red moves. Number 2, identifying intraday trend join long opportunities. The trend is your friend. This famous saying is especially true this year when we're experiencing a bullish stock market. As a trader, you want to learn to ride the trend to the upside instead of fighting against the trend. And more importantly, you want to avoid a choppy sideways price action. I'll show you my personal favorite, the trend join long setups in this video. Number 3, a powerful chart pattern that actually works. This is an advanced technical analysis skill set that requires years of trading experience. One way to develop the ability to recognize a developing chart pattern is to study the trade examples and practice. However, please don't worry if you're new to trading. I got you. In this video, I'll share with you a beginner-friendly and highly repeatable trading strategy so you can start trading with real setups that work. And number 4, the best trading indicators that work for momentum trading, for day trading as well as swing trading. Many of you traders out there know that my number 1 trading indicator is VWAP. However, I've actually been using a new indicator in my day trading, the 8 EMA. I've tested this indicator and found it very useful, especially when I'm analyzing the price action on smaller time frames, like the 2-minute chart. I'll share the juicy tips and findings with you so you can try both the VWAP and 8 EMA indicators together for yourself. If you're new to trading or if you're still struggling to achieve consistency, this video lesson will provide you with new concepts for technical analysis that you can focus on. It does take me a lot of time and effort to create these educational videos here on YouTube. So if you don't mind, please remember to smash the like button. And also, use the comment section frequently down below whenever you have any questions to ask me or any feedback to share. Without further ado, let's dive into the first technical trading technique. The number 1 technical analysis technique that I want to share with you today is a more effective way to identify key daily levels on your chart. For the beginner traders out there, let me quickly explain what support and resistance are before we move on to the more advanced price level analysis. Really quickly here, support or demand zone is like a floor under a price. When the price level falls down to a certain level and doesn't drop any further, that level is seen as support or demand zone. That's where buyers tend to step in, thinking that the price is now low enough to buy. On the other hand, resistance is a ceiling above a price. So when the price goes up to a certain level and cannot go up any further, that level is seen as resistance or supply zone. This is where sellers often appear, thinking that the price is high enough to sell and take profit. So how exactly do you draw basic support and resistance levels on your chart? It's very simple. I've made many detailed videos on this channel, but let me give you a quick demo. So you always want to start from the daily chart. You're looking for areas where the candlestick wicks at the bottom have been picked up. So essentially you can see over here, this is a very clear one. Stock sold off to that level and then got bought back up. So that's going to be a potential support area. Same thing over here. You can see stock dipped over here and got bought back up and went up higher. Same here, you can see multiple wicks at the bottom. Those indicate areas where people stepped in to buy the stock. So once you know that, you can see there's various support areas here as well as down here. You just want to identify all the wicks, and that's where in the past people have stepped in to buy the stock. So these lines that we just drew on the chart became reminders that this is a potential area of support or demand area where price may either hold and bounce back from here, or if it does break down, it can sell off even more aggressively. So resistance levels are areas on the daily chart where sellers have stepped in to sell. So instead of looking for wicks at the bottom of the candlestick, now you're looking for wicks at the top, meaning that when the stock broke out to those areas, people sold into the breakout. So this is where you can see long wick on the top. This is the resistance over here. Some other ones here as well here, and definitely all the way up here around 140s today. And then you can see somewhere over here. And this is where you can see that a lot of the resistance levels we just drew out are actually interchangeable with previous support areas. As you saw just now, identifying support and resistance is actually extremely simple and effective. These levels can now be used to create and form really good entries for technical setups, such as the daily support dip buy. Remember, the entries will be at extreme support areas, the back holder daily short, where the entries on the short side will be on the daily resistance levels. And finally, the technical scalping strategies, where your entries will be at the intraday support areas and exits will also be intraday resistance because you're scalping the range. So now that we covered the basics and the most important foundation, let's move on to the next important level you need to know, the intraday level of previous day's closing price. Now, the same horizontal charting technique you just used for support and resistance can be used to identify a more psychological price level for intraday trading, which is called the previous day's closing price. Just like the key daily support and resistance levels we talked about, previous day's closing price actually plays a huge part in technical trading setups, such as the first green day bounce, the first red day short, and scalping strategies. So we're looking at the intraday chart for NVIDIA. This is a trade I did a couple of months ago. This is when every single day NVIDIA is gapping up and making new all-time highs. Now, the dotted line you see here, this is the previous day's closing price, meaning that if today is a Tuesday, hypothetically speaking, the previous day's closing price is the last print at 4 p.m. on previous day on a Monday. So for this particular day, you can see the previous day over here, NVIDIA closed at around 887. And the next day, you can see pre-market, the stock is gapping up to around $900. This is what we call a gap up overnight. And overnight gap ups are very useful concepts that you should know, especially if you want to day trade or even swing trade for that matter. Technically speaking, if you see a chart like this one where the next day you have an overnight gap up above the previous day's closing price and the stock's daily chart has been uptrending like so, then there's a high chance and high probability that the stock is going to keep on trending up to new highs. So as you can see, this is the reason I went long and tried to buy the dips on NVIDIA and keep on trading it and riding it to the upside, because this is a time-proven strategy, which I also call the gap up reversal long, as well as the trend join long setup, which we'll talk about later on in the video. So now that you understand what's a gap up overnight, you should also understand what's a gap down below the previous day's closing price. So on this chart example over here, we're looking at the daily chart on these two particular days. Now you can see the previous day's closing price for this stock, GameStop, on this day is over here. The stock closed at $40. Now the next day, the yellow part is extended hours trading, after hours, and pre-market. The next day, you can see the stock opened at $34. So instead of gapping up above the previous day's closing price, you are gapping down. So $40 previous day's closing price, but pre-market you're trading a lot lower, right? We're talking about $33, $37, and open at $34. So this is a technical gap down. And this is where the inverse of what we talked about for NVIDIA will be most likely true. If you have a stock that has been, kind of extended recently and started selling off and have multiple gap down days, like this one, you can see a gap down once here and once here over here, and actually one more time again, then most of these gap downs, at least on the first 2 to 3, they're going to be potential good entries on the short side. You can see every single time GameStop gap down, after these huge red day, gap down here, stock sold off, you close at $40 previous day's closing price. Next day you gap down, you popped a little bit and sold off even more to $29. And the same trend kind of continued all the way until it went all the way down to $20. So this is how you leverage previous day's closing price with the overnight gap ups for a potential long. If, of course, all the daily charts criteria we talked about, you see it on the uptrending side, or if the stock is gapping down after a huge daily exhaustion candle like the one you see here for GME. And this is the reason why a lot of pro traders are momentum traders, because you essentially just need to scan for these overnight gap ups or gap downs for the best place on the day. Remember, whenever you have a gap up or gap down overnight over the previous day's closing price, that means at the open, you're most likely going to get the biggest range and the biggest moves in the market. So how do you exactly find these overnight gap ups or gap downs? Well, that's with a scanner. The scanner I use every single day, and you can see here on the template here, I categorize them into the small cap gap scans as well as the large cap gap scans. And the scanner I use is Stocks.io. So really quickly, overnight gap up scans, the ones criteria I use is over here, I'll sort it by gap. But for the large caps, I'm looking for volume above 20,000, gap percentage greater than 3% on the day, market cap, and float. Okay, so this is how I look for overnight gap ups, and I just sort it by gap percentage over here. Now for the gap down trades I take, I'll use a gap down scan over here. I click it, and then instead of sorting by the highest percentage, I'll sort it by the lowest. So I want to see the biggest gap downs on the day. So you can see this is down 8%, 8%, 5%, etc. So the only thing that changed between the gap up and the gap down scan is the gap percentage. I have it at -1%. This is how I scan for large cap gap downs. And you can do the same for small caps as well. But for small caps, I mostly look for gap up plays on the small cap side. And for this one, the criteria, I'm scanning for at least 10% gap. And the market cap and volume are a little bit higher for small caps as well. I would say though, for the gap up, I will scan for both small caps as well as the large caps. However, for the gap down plays, I only focus on large cap side. So is this making sense and getting interesting for you? Hopefully it's not too nerdy. We're talking about previous day's closing price, overnight up or down momentums. Let me know if you have any questions down below. And as promised, I want to explain these more advanced price level charting and then actual trading setups with you in a simplified manner. So please let me know down below if this has been straightforward for you. And please remember to give me a tap on the like button as well. Okay, moving on. Next, I want to explain another very crucial and oftentimes very profitable price action trading techniques around the previous day's closing price again. The red to green, or the inverse, the green to red intraday price movements. And these are some of the fastest and also the simplest trading setups as well. This trading technique, once again, requires the previous day's closing price as a key level on your chart, so make sure you have them. So I want to show you this example here of a GameStop trade that I did. I actually stopped out of the short side because I can see that you can see this dotted line here. This is previous day's closing price. Now, stocks, especially momentum stocks and these highly shorted stocks like GameStop, they have this tendency that if they go red to green, meaning red is below the previous day's closing price, they went from below to above the previous day's closing price, the key level, then they usually generate a huge squeeze to the upside. So you can see I was short once I identified that the stock is potentially trending higher and testing that red to green areas again and again. I want to get out because otherwise I'll get squeezed from, you can see, from $30.50 all the way to $33.50. Now, even though I was on the short side, you can certainly play this on the long side as well when the stock goes red to green around that previous day's closing price. Now, very important, this is a nuance I want to share with you. This kind of movements, whether it's red to green or green to red, the kind of move and the breakouts or the breakdowns are going to be the strongest after about 10:30 to 11 a.m. So you can see this red to green move happened at around 11 o'clock here. But the ones in the morning, the one that happened around 9:40 or 10 o'clock, this one failed and failed again here. Usually after 11 is where you see the strongest momentum moves. Adding on top of what I just shared with you regarding the red to green moves, another important thing to know that these red to green moves are gonna be the strongest after at least 1 to 2 previous days of red days. This is why we also call this particular setup as the first green day. You can only have a first green day if you have 2 red days before that. So an example I want to share with you is over here on SMCI. So over here, you can see that this stock had a huge red day here. 1 red day, 2 red day, 3 red day. Now, immediately after that, it gapped up and I have had a very, very strong green day. So you want to time ideally, these kind of red to green moves with also the first green day. That's how you're going to have the highest probability and the most range to the upside. So now that you understood the upside, let's flip it over and see the first red day or the green to red move. So you can see here, this is the stock SMCI. We want to look at this particular day over here. You can see that this day, the previous day closing price is around $1,006 over here because the day previous, that's where the stock closed at over here. So this is the previous day's closing price. Now you can see once the stock gapped up pre-market at the open, this is the open now. Well, I'm using 15-minute chart to show you really clearly. Now when the stock went from green to red under the previous day's closing price, it tanked hard. I mean, you can see the stock tanked from $1,006 all the way down to $920 and then $880 and continued lower to $800. So on this day, I think the stock sold off for more than 20%. Now again, this move is so strong and so heavy and volume was so high because it had many green days right before this, right? 1, 2, 3, 4, 5, 6, 7, 8, 9 days of green day. So just keep that in mind. If you have, consecutive green days before a very strong green to red move, your red day on the short side, you can expect a lot of range to a downside. Now, vice versa, going back to what we said about the first green day and the red to green move, if you had, consecutive 2 to 3 red days before this, your first green day is going to be equally as strong. So as you can see, the previous day's closing price is a very simple psychological price level. However, you can trade so many different strategies that are technical around that particular area. Not only can you incorporate the gap up or gap down strategies, but also the concept of first green day or the first red day, or the red to green or the green to red moves in your trading plans. So make sure you're always aware of where the previous day's closing price is for any of the stocks that you're trading, whether that's on the long side or the short side. Okay, before we move on to the next technical trading concept, I want to remind you that you can sign up for my free weekend watch list every single week. I send out trade ideas for day trading and swing trading on an email every Sunday. You can sign up for them for free down below. Let's move on to our third technical analysis concept and trading setup, which is identifying intraday trend join opportunities. Spotting and joining the trend has been my personal favorite trading setup this year. And that's because the market has just been going up and up every single day this year. So why limit your profit upside, right? So I have two trading setups that are essentially built on trend trading, namely the trend join long and trend join short. So what exactly is a trend? Let me jump straight into the golden tip and keep things simple for you. So the easiest and the fastest way to identify a trend is to zoom out on your chart, whether it's intraday or daily, and see if the price is clearly trending or moving up like a ladder, taking one step up at a time. Remember the concept we talked about earlier? So you can see here, let's take a look at the daily chart for Apple. You can draw a trend line, sure, a lot of people do that. But the simplest way to see is whether you see higher highs and higher lows on the daily. You can see over here on Apple stock, the previous day's all-time high was around 198 over here. And ever since leading up to the all-time high test, you can see the stock gapped up and sold off, but it kept holding the lows. The low of the day on each day is higher and higher. Even after it broke down, it reclaimed. You can see it keeps on making new higher highs, and then boom, breakout above previous high, all-time highs. And then the stock is keeping up. You can see the low on this candle is a lot higher than the all-time highs, and the stock just keeps on making new highs every single day. So this is a very clear uptrend because once again, higher highs, higher lows. So now that you understand the daily charts, let's take a look at intraday chart. So my two favorite days to trade the trend join long setup will be if the stock is breaking above all-time highs or previous 52-week highs. So my favorite days will be to trade on the first day and the second day. So if you zoom into the intraday chart, you can see that on the 5-minute, the stock is barely pulling back. This is how you know a trend is strong. Is that it doesn't even pull back to VWAP, right? This blue line here is VWAP, volume weighted average price. A lot of times it acts as the intraday support, where if the stock breaks out and pull back, that will be the area for entry. Now, how I personally know when a trend on a particular stock is very strong is that it's very difficult to find an entry. That's how you know it's strong, because you can see it never pull back. So if you're waiting on the 5-minute, waiting for a pullback, unless you join these tiny little pullbacks, you never get to join near VWAP. Okay, so that's how I know a trend is strong. But don't worry, later on in the fourth part of this video, I'll talk about how I use an indicator to help me get into an entry on these stocks that just don't pull back and you don't want to chase. But essentially, an entry on the long side is triggered when the stock on these kind of strong trending charts like this, when the stock is breaking above the after hours highs or the pre-market high. So you can see on this particular day here, Apple broke through pre-market highs of 207, and you can see the stock just takes off. On the 5 minutes, this one you actually have an entry here on the second day. You have a decent breakout to 218, stock pull back on 5 minutes, close enough to VWAP. So I would then get in here, risking below VWAP. So you're risking about $1.50, and the stock back to testing new highs. This is a kind of trend join long setup that I love to trade. So a couple of key takeaways here for this trend join long setup is that I'm using a 5-minute chart to identify potential entries, ideally closer to VWAP dip. And if the stock never pull back to VWAP, it's a sign that the trend on the stock, the momentum is extremely strong. So yeah, I just want to share with you my perspective on how I trade this trend join long setups to the upside. I don't draw trend lines. You could if it helps, but for me, I just use the time frame, the 5-minute chart, and my indicators. Okay, speaking of trend join long, an important technical and psychological level you should keep in mind of is the all-time high level or the 52-week high levels that we mentioned earlier. This is very important since we're experiencing a very, very bullish stock market. And you can see that S&P and the big tech companies are literally trading at new all-time highs every other week. So that's why when I see this, I know I need to stop shorting these very strong tech stocks like the Nvidia or even Apple. Remember, whenever these stocks are breaking through new all-time highs and making new highs every single week, technically, they have no resistance at all because it keeps on trending up higher and higher. People are still buying the stock, despite that the stock has never gotten to those levels before. This will be true on Nvidia as well. You don't want to be that person who tried to short Nvidia at $100 post-split price, 100, 105, 110, saying that it's just too extended. Well, the stock can keep on going up higher. So that's why I think there's more money to be made from the trend join long setups in a market like this. Like this is a really ideal market for the long side. That's why I do not short stocks that are trading close to or above previous all-time highs. And this is the foundation of some of my biggest trades this year, such as my 6-figure swing trade on Nvidia. That's leveraging the fact that the stock has been making new all-time highs for days and weeks straight. And I know you're going to be asking me, how exactly do you find these trend join long setups? Very simple, using the gap scanner that you saw on Stocks.io. Because stocks that are trading up to new all-time highs every single day, they will show up on the gap scanner. And I sorted by gap percentage. A lot of times, the large caps like Nvidia's, they'll show up all the way down here, 3% gap up. You can see Nvidia once again today gapped up 3%. But this is how you find stocks that are trading at new all-time highs or near all-time highs. Is when there's a significant gap that'll give them the momentum after the open to continue up higher for the trend join long setups. If you have any question regarding this particular setup, let me know down below. I'll be happy to help you out. Alright, moving on to the fourth technical analysis trading technique, and that is chart pattern recognition. Okay, before we go any further into the chart pattern, all the shenanigans, there's actually only one chart pattern that I actually like for day trading and swing trading, specifically the pattern itself, okay? And no, it's not the double top, double bottom, head and shoulders, or the cup and handle. Well, yes, those chart patterns that you can see on screen, they're great to know. I find the success rates for these to be 50-50 because these are probably the vaguest chart patterns out there. Remember, I'm talking about strictly trading chart patterns without any other technical analysis, any other fundamental analysis on the ticker. So I do think most of the chart patterns out there are very vague. And what I mean by that is you can see different patterns on different time frames, even if you're viewing the same ticker and the same candles. And that's the reason I don't trade based on chart patterns most of the time. I use them as reference points to my existing strategies. And what do I mean by that? I'm going to show some examples here on the screen. Let's say I'm trading my daily support dip buy setup already, and if I happen to see a double bottom on the 5-minute chart, then that's great, and it helps to confirm my thesis and my entries. Or vice versa, if I was in an extended daily short setup and I see a double top at pre-market high, then that just gives me more confidence to stay in the trade and stay in my winners longer. So once again, I almost never trade solely based on just seeing the chart pattern. But there is one technical chart pattern that I really like, and that is the downtrend break chart, ideally on the daily chart. So what I mean by that is, over here, there's a daily chart of Oxy. You can see the stock has been staying below this 8 EMA for a while. The stock has been downtrending since the 70-75 level in April of this year and sold off all the way down to $60. So if you draw a trend line here, you can see that this is a huge downtrend on the daily chart. Now, what I mean by a downtrend break is obviously when you have a chart that's in a downtrend on the daily chart for this 2 months straight. Now suddenly you finally have a gap up and the stock is now breaking above the downtrend. So this is what I mean by a downtrend break. This is a chart pattern for a very specific long strategy that one of my coaches in the Humble Trader community developed. He calls this the backside long strategy. This is developed by Coach Adam. So Adam uses this chart pattern for day trades and swing trades. Essentially, when the stock has stayed in a downtrend like you see over here for a long time, the first day or the second day, consecutive day, you see a gap up, and that's where he'll take the entry, hence breaking above the long-term downtrend. And once again, this tends to be a very good long entry for day trade and swing trade. And you can see his thought process over here. So currently he's swinging the stock Oxy. He took the long with the option side. So he's using a lot less capital than normal, not buying the shares like I do. But he took the options for Oxy. He took them here and then they scaled up some of it. But I think the idea is that they'll write it into 64, 65. So this is a swing trade that he's been taking. And he took it on the first gap up day over here. Once again, this downtrend break chart pattern is one of the only ones that I will look at and take the trade based on simply the pattern because it's very clean and the success rate is really high. I don't see this as vague as all the other ones we talked about earlier, like cup and handles, double bottom, double top, etc. Adam was previously interviewed in the Humble Traders podcast as well. He specializes in options trading for large cap stocks, including the SPY, as well as trading futures. His one-on-one strategy mentorship program is now open for application once again. The feedback from our members for his private mentorship sessions have been very amazing so far. Space is very limited because it is one-on-one, so make sure to check it out with a link down below. I know we covered a lot in this video so far, but we must talk about my personal favorite trading indicators. As you probably already know by now from a lot of my YouTube videos, I'm a price action oriented trader. Yes, I do trade momentum, but no, I do not rely on most conventional indicators. I don't use any of the fancy indicators that you guys have, like the RSI, the MACD, the Bollinger Bands, or the Ichimoku clouds. That's the pretty one. I really like that one. It looks really pretty, but I don't use it. Because I find most indicators to be lagging, right? These are all moving indicators. If you're using that as a confirmation for entry, I find that my entry is usually late. And that's why I prefer to just use price action and candlesticks. But as promised earlier in the video, I've recently added a new indicator for both day trading and swing trading. And that is the 8 EMA pair. So when it comes to day trading, I'll pair the 8 EMA with VWAP indicator. So on the screen over here, you can see a chart of my trend join long setup. Going back to what we talked about earlier, a lot of the trend join long setups, when the stocks are breaking above recent all-time highs, sometimes when the trend is so strong, on the 5 minutes, as you can see, it doesn't really pull back to VWAP. You can see that here it did pull back to VWAP, and that's great, but sometimes they simply don't. So that's where I use the 8 EMA, this blue line intraday here, as my entry point whenever I see a stock is trending so strong that I cannot find the entry. So I'll use this 8 EMA as a guide to see whether the momentum is staying strong. If I use as an entry, I'll see if the stock is riding along the 8 EMA on the 5-minute chart. You can see the stock is holding up well above the blue line here and steadily go up higher and then sell into the breakouts. This is an indicator introduced to me by my friend Keith, who was previously on the podcast as well, and it's a very useful momentum indicator. And I will use the same for swing trading as well. As you learned probably from my swing trading crash course videos, you know that I like to swing trade stocks that are above the daily SMA. You can see this purple line is the daily 200 SMA, as well as the daily 8 EMA, the orange line here. So I'll use the 8 EMA on the daily as an indicator for potential entries. So same idea, NVIDIA, just because it's a simple stock to use as an example. When I was swing trading NVIDIA a couple of weeks ago, I was using this 8 EMA as a guide. So I entered on that particular day, and I rolled all the way up to around over here, to 122's after a split adjusted price. But I never stopped out because the stock never broke down that 8 EMA. So that's how I use 8 EMA as a guide, even when it comes to swing trading. And that's why I was able to stay in the swing trade for so long. And I'm using this 8 EMA indicator for some of my current swing trades as well. Hopefully you understand all 4 of the technical trading techniques and the various setups we talked about today. We covered a lot of different momentum strategies that each of these techniques apply to. We talked about red to green, momentum trades on the gap up and gap down, trend join long, as well as scalping and swing trading as well. Remember, for a lot of these momentum trades and the gap up or gap down trades, I'm using stocks.io to find stocks to trade for me. You can use a lot of these built-in templates, or hide them and build your own as well. Make sure to check them out with the link down below. If you enjoyed this technical trading techniques video with all the various setups, then you should definitely check out my technical analysis crash course for free over here.